Every year, millions of ordinary people open brokerage accounts, fund them with real money, study charts and headlines, and make what feel like rational, informed decisions about where to invest. And every year, the data tells the same quiet, uncomfortable story. The majority of retail investors, not a small minority, not the unlucky ones, not the undisciplined ones, but the broad, consistent majority, underperform the very market they are participating in. They would have done better, in most documented cases, by doing nothing at all, by purchasing a simple index fund and never opening the app again. The question that deserves a serious answer is not whether this is happening. The data on that is clear and consistent across decades and geographies. The question is why, and the answer has almost nothing to do with intelligence, access to information, or work ethic. It has everything to do with the way the human brain was built, and the specific, predictable ways that a brain built for survival performs poorly inside a system built for capital allocation. To understand why retail investors consistently underperform, you first have to understand what the stock market actually is at its most fundamental level. It is not a casino, though it shares some surface characteristics with one. The stock market is, at its core, a system for aggregating the collective beliefs, expectations, and emotional states of millions of participants simultaneously, and translating that aggregate into prices. Those prices, in the short term, are driven as much by sentiment, fear, and narrative as they are by the underlying financial reality of the businesses being priced. In the long term, fundamentals tend to win, but most retail investors do not operate on long time horizons. They operate on the emotional time horizon of right now, reacting to what the market did today, this week, this month. And it is precisely that mismatch between the emotional time horizon of a human being and the fundamental time horizon of a market that produces most of the underperformance the data documents. The Dalbar study, one of the most cited pieces of research in behavioral finance, has tracked the difference between what the stock market returns and what the average retail investor actually earns over the same period for more than 30 years. Over a 20-year period, the S&P 500 produced annualized returns of approximately 10%. The average retail investor earned approximately 4 to 5% over the same period, less than half the return of the market. They were investing in the behavioral economics. Explanation for this gap begins with a concept called loss aversion, one of the most robust and replicated findings in all of psychology. Losing $100 does not feel like the equal and opposite of gaining $100. Psychologically, the loss feels approximately twice as painful as the equivalent gain feels. Pleasurable, this asymmetry likely evolved as a survival mechanism in environments where losses were genuinely more consequential than equivalent gains. But inside a stock market, where short-term fluctuations are a normal and expected feature of long-term wealth generation, loss aversion becomes a systematic liability. The same brain that kept our ancestors alive is now working against our financial interests. When a portfolio drops in value, even temporarily, even as part of a normal market correction that history suggests will reverse, the psychological pain of that drop triggers the same neurological threat response that evolved to protect human beings from physical danger. The brain does not distinguish cleanly between a tiger and a portfolio loss. It registers threat, elevates stress hormones, narrows focus, and urges action. Sell, get out, stop the pain. And that urge, that entirely predictable, neurologically normal urge, is precisely what causes the retail investor to sell at the bottom of a correction, locking in a real loss from what was previously only a paper won, and then miss the recovery that follows. This is compounded by a second behavioral tendency called recency bias, the cognitive shortcut through which the human brain treats recent events as more representative of future outcomes than the longer historical record supports. When the market has been rising for 18 months, recency bias tells the retail investor that it will keep rising. When the market has been falling for 3 months, recency bias tells the investor that it will keep falling. The result is a systematic pattern of buying high and selling low that is the precise opposite of what generates returns, and it is driven not by stupidity, but by the predictable operation of cognitive shortcuts that work. Well, in most environments and catastrophically in this one, the pattern repeats. The data confirms it, and it continues because the underlying psychology never changes. The mathematical cost of these behavioral tendencies is worth calculating precisely. Consider an investor who puts $10,000 into a broad market index fund in the year 2000 and holds it through every correction. Every crash, every headline, every moment of panic, the dot-com collapse, the 2008 financial crisis, the 2020 pandemic crash, and without selling, without rebalancing in fear, without doing anything at all. By 2024, that $10,000 would have grown to approximately $70,000, a seven-fold increase driven entirely by patience. Now consider the retail investor who responds to those same events the way loss, aversion, and recency bias predict they will. They sell during the dot-com collapse, re-enter after the recovery is already underway, sell again during the 2008 crisis, wait for stability before re-entering, and exit again during the 2020 crash. Each of these moves feels rational in the moment. Each of them is supported by headlines and the emotional logic of avoiding further pain. The cumulative result is somewhere between 30 and 50% of what the completely passive investor earned, with significantly more stress and significantly more time spent watching. The J.P. Morgan Asset Management Guide to the Markets has repeatedly illustrated what happens when an investor misses only the 10 best trading days in the market over a 20-year period. Missing those 10 days, out of approximately 5,000 trading days, reduces the total return by more than half. 10 days out of 5,000, and missing them cuts the outcome in half. The research consistently shows that those best days tend to cluster immediately after the worst days, meaning that the investor who sells during a crash to avoid further pain is statistically likely to miss the sharpest part of the recovery. The cost of reacting is not just the loss locked in at the bottom. It is the recovery missed at the top. At a systemic level, the underperformance of retail investors is not an accident, and it is not a mystery. The financial media ecosystem, the constant stream of market commentary, expert predictions, breaking news alerts, and portfolio performance notifications, is calibrated to generate engagement. And engagement in financial media is generated most reliably by fear and urgency. A headline reading, "Market continues stable upward trend, no action required," does not generate clicks. A headline reading, "Analysts warn of imminent correction, should you be selling now," generates enormous engagement. The information environment that most retail investors navigate daily is systematically biased toward the kind of emotional activation that produces exactly the behavioral patterns that destroy returns. This is further compounded by the structure of brokerage platforms themselves, the gamification of investing, real-time price updates, push notifications for portfolio movements, one-tap trading interfaces, confetti animations for completed trades, is not designed to help retail investors make better long-term decisions. It is designed to increase trading frequency, because trading frequency generates revenue regardless of whether the trades improve or damage the investor's outcomes. The retail investor, sitting at the center of this system, bombarded by fear-generating media, equipped with frictionless trading tools, guided by cognitive biases that evolved for a completely different environment, is not making irrational decisions. They are making entirely predictable decisions given the conditions they are operating inside. Understanding those conditions is the first step toward changing the outcomes they produce. Understanding this reframes what good investing actually requires. It is not primarily a knowledge problem. The information needed to outperform most retail investors, buy a diversified low-cost index fund, contribute consistently, do not sell during corrections, hold for decades, is freely available, widely published, and takes approximately 15 minutes to understand. The knowledge is not the barrier is behavioral. It is the gap between knowing what the evidence recommends and being able to execute that recommendation through a market crash when every instinct, every headline, and every notification on your phone is telling you to act. It is the gap between understanding intellectually that short-term volatility is the price of long-term returns and experiencing that volatility emotionally as a genuine threat. It is the gap between the rational financial self that reads articles about passive investing and the reactive psychological self that opens the brokerage app at 2 a.m. during a market correction and makes a decision that will cost years of compounded returns. Closing that gap is not primarily an educational exercise. It is a structural one. The investors who consistently outperform their behavioral peers are not those who feel less fear during market downturns. The research suggests they feel it just as acutely. They are the investors who have built structures that make acting on that fear difficult or impossible. Automatic contributions that invest regardless of market conditions. Deliberate friction introduced into the selling process. An advisor whose role includes talking the investor out of reactive decisions. The strategy is not to feel differently. It is to make it structurally harder to act on the feelings that the market and the media ecosystem are reliably going to generate. Stillness in the middle of the storm is not passive. It is the most active and disciplined financial decision, available to a long-term investor navigating a system specifically designed to make stillness difficult. The retail investor underperformance gap is one of the most well-documented phenomena in all of behavioral finance. It has been measured across countries, across decades, across market cycles, and across different types of investors. And in every measurement, the same pattern emerges, not because retail investors are less intelligent than the market requires, but because the market requires something that human psychology does not naturally provide. It requires the ability to hold still when every evolved instinct says move. To stay when every headline says leave. To trust a decades-long historical record over the emotional weight of what is happening right now. Market return minus behavioral cost equals actual investor return. That equation is simple. Executing it consistently is not. Recognizing that demand clearly, understanding that the primary challenge of investing is not analytical but psychological, is the beginning of engaging with it honestly. Same market, same fear. Different structure, different outcome. The market does not change. The behavior around it does. And that behavioral difference, compounded over decades, produces financial outcomes that are not remotely the same. The investors who capture what the market offers are not luckier, smarter, or better informed than the investors who do not. They are more structured. They are more deliberate about the conditions under which they allow themselves to make financial decisions. And they have understood, at a fundamental level, that the enemy of long-term investment returns is not the market. It is the reaction to the market. If this video gave you a clearer understanding of why investment returns are lost not in the market, but in the behavioral responses to it, take a moment to like it. It helps this kind of evidence-based financial education reach the people who are making these decisions right now, without the framework to understand why their instincts may be working against them. If you know someone who has sold during a market crash, avoided investing because the timing never felt right, or watched their portfolio underperform without understanding why, share this with them. And if you want to keep exploring the psychological systems and structural realities that shape real financial outcomes, subscribe, because that is exactly what this channel is built to deliver.